Okay, let's answer some questions from Sunday's market outlook. But first, let me start with a message here, a public service announcement. I will never ever ask you in the comment section to connect with me on WhatsApp. If I want you to connect with me, I'll give you my email. Simple as that. I'll give you my email address. There is somebody, some loser, and it is a loser, who's using my logo as their thumbnail picture for their username, and responding to some of you saying, contact me on WhatsApp for some trading ideas. It's just a Bitcoin scammer. Well, I don't know if it's Bitcoin, but it's just a crypto scammer. Each week when I put up a video, actually not just each week, every video I put up, if you scroll through the comments, you'll find that they're very, very clean. There's not a lot of spam in the comment section. That's because I delete them the moment they appear. I get a notice on every comment. The moment it goes up, I get a notice on my app, on the YouTube Studio app. And if it's this scumbag stuff, I delete it. I must delete 40, 50 of these on every single video. And they're of two types. Either come to my porn site, or let's talk CRYPTO. Let's talk crypto. Porn and crypto. Porn and crypto. You know, this is why I say, what's the point of this thing, this crypto thing? It just seems to me that every scumbag in the world is into crypto. Now, not everybody into crypto is a scumbag, but think about the scummiest person you know and ask yourself, are they involved in crypto somehow? And I bet you the answer is yes. Anyways, I will never push crypto. I will never push porn sites. I will never ask you to contact me any other way. So if you get this loser commenting on any of your comments saying, hey, contact me, just understand it's not me. Okay, let's go. What do you think about preferreds in this market as a way to generate income? Yeah, you can use preferreds. Preferreds typically hold their value fairly well in and around the $25 mark, because most have a par value of $25. The issue with crypto is the issue with preferreds is very little in the capital gain space. They'll fluctuate in price much like a bond will fluctuate in price if the interest rates in the market are higher or lower based on the risk of the security than what the market would want. You might get a discount from par or a premium to par. You can do the same thing. If you look at some of the dividend yields on preferreds, you can do the same thing by getting a dividend yield on a stock that might be lower but selling calls above the strike price of the equity that you buy. Well, now you have some capital appreciation up to the call price, right? And you'll get your dividend yield here. So if you're finding preferreds that are paying 8%, you can find an equity REIT that's paying 4 to 6%, and you can sell 30 delta calls or even 20 delta calls and probably do better than the 8%. And if it does go up, well, then you get some capital appreciation. I think preferreds are a good thing to hold in your portfolio as you age, as you get older and you feel you don't want to be in equities, but that fixed income isn't really giving you much. Then I think bank preferreds and some REIT preferreds are a nice place to be. I haven't seen you demonstrate how to utilize bonds, fixed income to express a market view. Given your fading equity rallies, are you considering adding these to the mix? Well, right now the correlation between stocks and bonds is positive. Typically if you're going to short the market, it would be the same thing as buying bonds, typically. But right now, if you're going to short the market, you may as well short bonds. If you're going to buy the market, you may as well buy bonds, because they seem to be moving in lockstep. This has been the case, I think, for the last 12, 13 years. The correlation has gone from a slightly negative correlation to a positive correlation. So I don't really see the point. Earlier in the year, I did use the TLT when it was late December, early January. I suggested when TLT was about 160 to sell 135 calls, in the money calls, and as TLT dropped, you'd make the money down to 135. I expected that to take some time, but it happened so fast. I didn't expect it to drop as fast as it did. You can also use IEF. This is the 7 to 10 year bond. Has less volatility because it has less duration, and these are for treasuries. There are many others. You can get ETFs that track investment grade bonds, high yield bonds. So just Google US ETF fixed income, and you'll find a whole bunch of ETFs. Just make sure they're liquid. Or you could use futures, any of the futures contracts. ZN is the 10 year for the N. ZF is the 5 year, F for the 5. ZB, that's the bond. It's just called the bond futures. This is the 30 year with the B in there. So there are different futures contracts that you can play. But if you're positioning as if there's a negative correlation between them, that negative correlation hasn't been around for a while. Okay, the next two questions here and here, the answer is related. First one, is there a correlation between the price movement of Canadian securities and U.S. monetary policy expectations? I own some Canadian REITs that have been rallying at the exact same moment as the U.S. market. Whenever the narrative of the Fed pivoting caught momentum, my REITs shot up. It doesn't seem logical since the Bank of Canada sets the rates for REITs situated in Canada. Up until now, I think that the Bank of Canada has been very hawkish and has not done something to tarnish its credibility. Does the Canadian market believe the Bank of Canada will also pivot or slow down rates? The correlation I've been seeing lately does not make sense to me. Next question is, why is it that with yields where they are and also higher Fed fund rate, yet the financials are breaking down? Should not they do better in this environment? So there are certain drivers of particular sectors. So this is the real estate sector up here, and it's the real estate sector in Canada, with interest rates being probably the big driver of day-to-day pricing, other than big fundamental information on the REIT. And there are certain drivers for banks as well, GDP being a big one. Because that drives loan growth. When we start thinking about a slowdown in the economy, you have to start thinking about increases in loan loss provisions, or of defaults, outright defaults on the loan book. Higher rates do help. It depends on how the bank has structured its balance sheet. What matters more is the spread between, let's say, the 3-month and the 10-year, or the 3-month and the 5-year, even the 6-month and the 5-year. The flatter the curve, the less desirable it is. So it's not just one thing. We can't just look at one metric and say, how come it's not working? And you can't look at one metric and say every day and say, well, this metric is moving this way. How come this is not moving this way today? It's over a period of time that a correlation happens, so that you can have your indicator doing this, and you can have your stock doing this, right? Not following exactly, but the correlation over time is what you're measuring. And a correlation doesn't mean that it's going to move that way every single day. So the same thing up here, just because there may be different drivers of Canadian REITs, it doesn't mean it's not going to get caught up with the general market's sentiment from time to time. It's not going to behave consistently every single day according to the indicators and the drivers, especially when it's near fair value. So let's say that you feel a stock has a fair value of $20. Typically plus or minus 10%, 18 to 22. There's very little fundamental motivation to do much in there. So what's going to push this thing around when it's near fair value is, well, the whims of the market. So that there may be drivers that drive the value of this stock, but it's sitting at its fair value anyways, and you might find, well, the indicator's up, but the price is down. It's just within this plus or minus 10% range. This is just noise, typically plus or minus 10%. So it's, from day to day, you can't expect that every relationship that typically drives the performance of a sector is going to be that way every day. It's over a period of time that it is that way. Let's see, next one. Do you have any thoughts on gold? It seems to be approaching multi-year support. I have no thought on gold. The idea behind gold is that if there's going to be massive money printing and massive inflation, that's where you want to be in gold, because that's really where it's going to protect you. Now you're saying it's approaching support. What better environment do you need? If gold was going to have its day, it would have had its day. What more? I mean, you basically rolled out the red carpet for all the gold bugs. You said, here's exactly what you've been saying all the years. All this money printing is going to lead to massive inflation and gold's going to 3,000. Well, we had that. We still have it. And gold's not going anywhere. It's approaching support. So my thinking is, listen, if gold was going to have its day, it would have had its day. It didn't. What am I buying it for? What am I hoping to happen on top of everything else? What's the next thing I'm hoping to happen that would be the catalyst for gold to go higher? The two big things have happened. They're here. They're going on right now. What would have to happen next? I think that if you're looking at gold in U.S. dollars, you may be conflating gold prices going down for the U.S. dollar strengthening. If the U.S. dollar weakened, maybe gold prices would go up. But that's just a relationship between U.S. dollar and gold. I don't think that that's going to have anything to do with the very things that the gold bugs, hit you over the head with all the time, is money printing, inflation, money printing, you're devaluing the dollar. Only gold will survive. Why is it not doing anything? All right, next question here. I know inflation is hurting the equity market now, but at some point inflation will transfer into GDP growth. I don't see why that is the case. My question is, when will inflation, such as high inflation period like 2022, like now, will transfer into GDP growth, then reflect on equity market? I don't see how inflation is supportive of growth. If you mean the GDP report that we get, GDP is reported in real terms, so real GDP. So when we say that GDP was negative 1.6% for Q1, that is real GDP. Nominal GDP was, I think, was it 6-7%? So you might be thinking that you're looking at the 1.6 saying, yeah, but when's inflation going to push this up? This is real GDP. You're thinking about nominal GDP. I'm only guessing because you're saying when is it going to transfer into GDP growth. The way I'm reading it is, when is inflation going to support growth? Inflation really doesn't support growth. It actually works against growth. So you might be thinking of nominal GDP. And when companies report revenues, they report revenues in nominal terms, and they report EPS in nominal terms. And when we look at the forward 4-quarter estimate for EPS at 235, that's already nominal. That's already got inflation in there. So if you think, well, shouldn't it be much higher because inflation is that much higher? The end result is, but prices are nominal as well. So if you discount discount all prices by the rate of inflation and discount all revenues and discount all earnings, you'd probably end up with the same relationships with the same PE multiples as you would otherwise, because all of these are in nominal dollars. So it's when you have inflation, your revenues go up, but your expenses go up as well. The question is, it comes in your margins. Can you maintain your gross margins and your operating margins and your net income margin? Because if your revenues can't scale up at the speed that your expenses are scaling up, you actually decrease your margins. Now, margins are a real measure, not a nominal measure. Because if you take nominal revenues and you subtract nominal cost of goods sold, you'll get a nominal gross profit. And if you take that nominal gross profit and divide it by nominal revenues, you'll get a real gross margin. So when you look at margins, they are real. They're on a real basis. So it's, I think I got the gist of your question. I think that's what you were asking. And the short answer is, it's already in there, except when we get the GDP report, those are real numbers. When we see earnings being reported, those are nominal numbers that already reflect the dollars they received and the dollars they paid. 4 other things on the screen here: LNG, Indian market, U.S. Treasury auction, and China debt. I was asked questions about that. I don't know enough about these things to give any kind of informed opinion. I know nothing of the Indian market. Nothing at all. Like nothing. U.S. Treasury auction, I know the process for the auctions, but as far as the amount of over subscription, whether it was not high enough or too high, I'm not an expert in that field at all. China debt, well, we know it exists. It's big in the property sector. That's the troubling one. But the banks have a whole bunch of issues with other debt as well. I just don't know. The data coming out of China is suspect at best. I don't know if I completely believe all of it, and I just don't know enough about that. Same with liquefied natural gas. These are not my areas of expertise. Here's my suggestion on these, because this is what I would do. If I wanted to know more about the Indian market, I would use Google. And I would just start Googling things, and I would make sure that I'm using reputable sources. And I would just start reading. And that's how knowledge is built, is you put in the time and you simply start reading. As long as you're using reputable sources, you should be good on that. Okay, all of these, and there was one more, there were 5 that all dealt with XHB, the ETF that tracks the home builders, because I have started building a position in that. So let's go through them. I'll try to answer them as I go, and then many of them touch on the same theme, so there'll be one answer I think that covers all of them. Touch a bit more on your investment thesis. Apparently there are many months of supply of homes under construction, over 7, and constructions to be initiated. Isn't this going to put downward pressure on home selling prices? Well, we get months of supply with a ratio. There's a numerator and a denominator. The numerator is your supply, all right, and your denominator is your annual rate of sales. So let's say that your supply is 1.2 million homes, and in month 1 you sold homes that once you annualized it, you get to about an 800,000 unit run rate for the year. You got 1.5 months of supply. Now let's say that the next month things fell apart. Housing fell apart dramatically, and you sold homes, but you had a run rate of 400,000, and some houses came off the market. Let's say that they went down to 1 million. You have 2.5 months of supply. Notice you went from 1.5 months to 2.5 months, and you decrease the amount of supply that you have, because you have a numerator and a denominator. If the denominator is dropping faster than the numerator is, you can have an increasing months of supply. Now, let's say that it didn't drop. Let's say it stayed at 1.4 and you went to 400,000. Now you have 3 months of supply. So you have 3 months of supply, but supply hasn't changed. So the months of supply, because it is a ratio with a numerator and a denominator, you have to say, well, what is making that ratio increase? Is it the numerator? Well, now supply is increasing. Is it the denominator? Well, demand is dropping. Demand is dropping, which, in the lower demand scenario, there's more supply for that lower demand, but the actual count of supply hasn't increased at all. Have the market's movements meaningfully altered your thesis on XHB? No, it has not. I'll expand more on that. About housing, you mentioned this time it's different in 2006, 2007 because the underlying credit behind mortgage holders is very good. Yes, it is. Despite credit, wouldn't you say there is a danger if many residential buyers are taking up mortgages at 6 to 7 times their annual salary, or even more? No. If you have the credit for it, then no. I don't see that as a problem. If many are first-time buyers, how is credit as relevant anyways? I don't understand why first-time buyers would make credit any less or more relevant than if I were a second buyer. If a second buyer is getting a mortgage, then credit is just as important as if I were a first-time buyer getting a mortgage. Seems many of the elements in the last crash, speculation, nope. Over leveraging, nope. Are in place, if not worse. No, they're not. The issue back here was a couple of things. Oversupply. You had a massive oversupply of homes. The second thing was anybody and everybody who wanted a mortgage was getting one, whether you could afford it or not, and there was massive fraud going on in underwriting. You had things called liar loans, ninja loans. There were a couple other acronyms. Ninja meaning no income, no job, no problem, you get a loan. Or is it no income, no job, no assets? Yeah, you'll still get a mortgage. Liar loans is just lie. You know, what do I put down for income? Just make it up. Make it up. Doesn't matter, because all of it was going to be securitized and put in MBS, and they were all going to get AAA ratings from the rating companies, because of course they were in on it too, because they wanted to get paid. That's what was going on there. So it was this oversupply that was killing it. If you had an undersupply at that time, well, then you could only give out as many mortgages as you could sell homes, which means there'd be no need to try to convince people to lie and to make stuff up. There'd be no fraud, because you would have so many good people that you wouldn't need all of those other people, because you had an undersupply. 1990, oversupply. 2006, 2007, oversupply. Now, massive undersupply. You don't have speculation. You don't have over-leveraging in that sense. So, no, I don't see this as a problem. Keep in mind, in 2006, the Fed had the Fed funds rate at 5.25%. 5.25. We're only at 2.5 right now. Expected to go to 3.25, maybe even 3.5, but we're only here. It was a 5.25, I think maybe even 5.5. You know, if people were paying for regular mortgages back then, they were 7-8%. But they were getting these teaser rates. So you pay 2% for 1 year, interest only, and then they'll reset. That created the crash. That created all of that. All of those houses had to come to market, because when those low rates reset, they couldn't afford it. Had those low rates not existed, you wouldn't have had all of that, because somebody coming along would have said, well, I can't afford it to begin with. But you can if it's 2% interest only for the first year. And the idea was housing prices are going up. So you'll get it here. In a year, what we'll do is we'll refinance, and you'll take this equity out. Isn't that beautiful? You can sell this house at this point and you can walk away with the equity. It's free money. Why wouldn't you take it? And in the meantime, you have this really low rate, and it was all premised on housing prices continually going higher and higher. With the latest CPI report, you see shelter and rents having significant impact to that number. How does rising interest rates entice home builders to increase housing supply? It does not. That's the beautiful thing. It does not entice them to increase supply. If they could increase supply, margins would drop. So you can sell two houses at 15% margin, or you can sell one house at 30% margin. That's where they are right now. Why work hard? As long as there is a tight market, gross margins are going to be high for a while. This hurts the small home builder, not the large home builder. Small home builders don't have the reputation and the gravitas to be able to build to spec and to be able to build in stages, to charge in stages. A large home builder does that. So you buy a house from a large home builder, you'll put your money down, and then there's a 60 to 90 day period. Usually once the foundation is laid, you owe a third of the house. So the home builder is getting financed along the way with the installment purchase of the house. They don't have to build the house first and then sell it. They build a third of it and they get their money. And then once the walls are up and everything is up, I think once the roof is on, you're owed another third. And then once it's delivered, you pay the final amount. But there are stages to getting paid. So if you have 30-point margins, by the time you hit the second stage, your costs are basically covered, right? And they were covered by the buyer. A small builder would have a very hard time convincing a buyer to pay in thirds because, well, who are you? What if you disappear? What if you go bankrupt? What if you take my money to complete somebody else's house? I don't trust you. So they mostly have to build to spec. Well, capital is expensive. So it hurts the smaller home builder, and the larger home builder benefits from that. So even though the amount of homes built won't increase, the concentration in the industry tends to increase when you have situations like this. Surely higher rates married with lower supply equal higher future rents. There you go. Yes, you need to think like an investor, not like a citizen. As a citizen, you would say, that sucks. As an investor, you would say, hang on a second, I just came to a conclusion. We have higher rates. We are going to have lower supply. It is going to be higher future rents. Let me in on these apartment REITs. You see that? So you have to almost be sociopathic to be an investor, because you have to look at something like this and say, that's where the pain is going to be for a lot of people. That's where I'll be. I want to own those things. Now, you're not contributing to the solution at all. You know that, but that's the social side of you. That's the citizen side of you. You can still be a good citizen and a good investor, but this is why I want to be in apartment REITs, because yes, this is going to be a multi-year problem, if not a full decade problem in the US. How do you solve that problem? Well, this is for government to solve. If it is a social issue, that's why I pay taxes. I give the government money, and they take some of my money and they say, we're going to do some good social things that the free market will not do. And I say, fair enough. Okay, fine. You go ahead and do that if it makes society better. If we're finding that government is abdicating its responsibility for making society better, well, then doesn't it lose its legitimacy? If you're looking to business to be more socially minded, what are we paying taxes for? What do we need a government for if we're looking to business to say, you got to do something about the homeless? You got to do something about child poverty. Well, I do. I pay tax. So I do something about that. You're complaining to the wrong person. I'm writing my check. You got to go complain to those guys over there that you elected. So if I were in government, how would I solve this problem? A number of ways. Number one is I would dramatically increase immigration for particular skills. Are you a carpenter? Are you an electrician? Are you a plumber? Are you anything that can help the labor shortage in the housing sector? And I would fast track you immediately. In you go, in you go, in you go, in you go. Number two, I would give the home builders, all home builders, small and large, interest-free loans or low rate loans if they built a house that sold for 80% of the average or the median selling price in their region, wherever they happen to be building. That means they're building smaller homes or they're building density. So rather than take an acre and cut it into 4 lots and build 4 houses, you would say, well, that's 16 towns. We're going to build 16 townhouses. Well, there's affordable housing. There's your starter home. As long as it comes in at 80% of whatever it is, you get your interest-free loan. So you're going to sacrifice on margin, but I'm saving you the interest that you would pay on the capital that you're using. That's about the only way that I can solve it, because government can't build anything cheaper than private sector can build anything. But I got a problem. If I do this, and I come up with a great program to incentivize building, and there is all of this building going on, and I say, Mr. President, I've solved the problem. In about 6 months, we're going to have a massive amount of supply. Well, I'll be fired, because he'll say, have you seen prices of commodities? Have you seen the price of copper, the price of lumber? Have you seen the price of rents in these cities that you're building where all of these immigrants had to come in and find a place to live? You're pushing up inflation. It is the wrong time to be building homes. It is the wrong time to be pushing supply side economics when we're trying to get inflation down. Even though it could help get inflation down, it would create an inflation bubble before it finally bursts. So what do? That's a tough place to be. How can you entice home builders to build more? You said the word right here. It's entice. There has to be rewards. Every action that humans take is built on one of two things: the carrot or the stick. So either there's a stick or a carrot. And you can figure out, well, if there's a stick, what punishment would it be? If there's a carrot, what incentive would it be? Everyone responds better to incentives than to punishments. So the better the incentive system, the more you can get it done. But the incentive system has to trickle down to their bottom line. That's all. Appealing to their social graces, saying, "Come on, you got to be a good corporate citizen." The answer to that is, I am. I pay the government money so that they can do it. They're in the business of doing that. Hey, look, I stay in my lane. I build houses. That's what I do. Then I give some of my profit to the government so they stay in their lane and they fix society. If society is not being fixed, that's on them. I've given them money to get it done. That's on them. Let's see. Doesn't the government get involved in regards to banning large financial institutions from buying up property? That's a tough one, right? Where do you put regulation in to say you shall not engage in certain types of practices? What if you had a massive oversupply, like you had in 2009, 2010, where housing prices were crashing? Had it not been for the large institutions stepping in to buy these homes, there might not have been a floor on these. Many more people would have lost more. So there are times where a particular action is your friend. But that doesn't mean that in every context you're in, your friend is always friendly. There could be a context in which you wish that they wouldn't do what they were doing, but you can't say, stop it now. Okay, now do it. Okay, stop it now. Okay, now do it. How do you stop private business? Now, you could have a second home tax, and this would deter the purchasing of it. But it's such an unimaginative thing to do, and I don't know so much that it would increase any supply. But a second home tax would be if this is your second home and it is not your primary residence. In other words, it's either a vacation home or an investment property home, there'll be this tax on it. That tax would end up being inflationary if it's an investment property because it would be purchased, and whatever that tax would be just a cost of doing business, and it would be reflected in the rents. Difficult to solve that. You have many pensions tied to large financial institutions provide significant funding to make those purchases to guarantee a good and safe yield. Yes, you do. I can only imagine there being massive fiscal stimulus coupled with regulation of some sort to solve this problem, or worse, perhaps just let it be and see a spiral of defaults, poor future credit scores. Well, it is a tough problem to solve, which is why, let's answer this now, which is why my thesis here has not changed. We have significant undersupply. That's well documented. Almost everywhere you look, almost any housing analyst you'll talk to will tell you the same thing. We have an undersupply. Household formation of 1.2 to 1.5 million units per year are needed, and we're building less than half of that per year, and have been doing that for quite some time. So there's a significant backlog that needs to be built. This period of high rates that we're going through is actually going to detract from more building. I know that on the conference call for the last earnings season, some home builders are saying they're no longer building spec houses. Spec houses is when you build a development, you build 40 houses without having buyers. You're just building them on spec because they'll sell. When you stop building spec houses, that means you will only build a house for a buyer. A buyer has to show up before you start building houses. So there'll be no increase in supply because the moment you start that house, it's already off the market. So it's not even supply. So coming out of this, when we do come out of this, we're going to have a housing shortage for a long period of time. And housing is one of those things where, well, what are you going to do? What's your alternative? You're either going to pay rent somewhere, in which case I own apartment REITs and I'm happy. Or you're going to say, well, let's just bite the bullet and get it done, and we'll take some of our parents' money and buy a house, in which case I own the home builders. But when I see a massive shortage in housing, I want to be on both ends. If you're going to rent, I'll get you with the REITs. If you're going to buy, I got you with the home builders. And then if I want to be a good corporate citizen, I will then donate money to good charities like Big Brothers, Big Sisters, on top of and I'm going to make some space here so you can see the actual number because it is a choking number. Let me just delete that. On top of the 53% tax I already pay. Anyways, that's it for XHB. I will continue to buy it. I've also got a straddle, a 60/90 straddle, 60 put, 90 call on DHI. And I recently PHM, I recently sold puts on Pulte Homes. And I had to fight myself yesterday not to do something with Lennar. But I'm going to, at some point, I'm waiting for the next big sell-off. If we break 390 on the SPY or 3,900 on SPX, I think we can make a run to 3,800 on a big washout. Maybe next week when the Fed moves. If they move 100, I think we could have a big washout day. I think I will add my next leg on those trades at that time. And this is a multi-year play. I'm not buying the home builders such that in 2 or 3 weeks on a nice little swing trade I'm going to make some money. I'm not doing that. This is a long-term play. They have a good dividend yield, nice liquid options. I can always sell calls at 15 delta, 20 delta to double the dividend that I'm getting, and I'm willing to wait. Well, that's it for today, and I will see you on Sunday.